Hey everybody, can you hear me okay? Quick little audio test here. Hey Michelle, Mark, good to hear you. Good to see you here. All right.
What the hell did I do with my truck?
When is it coming in with? Had microphones on. That's weird. All right. Hey everybody. Doug Robertson here. Can you guys hear me now? Okay. Did you get saved from that horrible reading of the disclaimer? Okay. Everybody can see the disclaimer. I don't want to read it again for the, because I'm sure every one of you have heard it forever. I'd like to apologize for the disclaimer, but I can't really because honestly, it's to save my butt. I think you guys realize that. I need to stay within the legal limits of everything, so I kind of have to do it. But there, I guess we missed it on that one. You get saved this week, Michelle. Let's see here. So let's just move on. Hey, a couple of little announcements. Did everybody get the Strategist View sheet that I sent out earlier this week? Okay, good. Michelle, if you didn't get that, please reach out to customer service and find out why you didn't. It should have looked, let's see here. Here's the word rough view of it, but it should have looked something along the lines of this. Information about the week, a couple of target opportunities, and things along those lines. So if you did not get that, please definitely reach out to T3's customer service and see why you didn't. Just so that everybody knows, we've got some plans that we've been working on that are trying to bump up some of the things that we're doing here. And once again, asked this last week, but I would like to keep asking. You guys are a core group for me, and I, want to listen to what you want. There's a few other things that we're going to be coming up with. One of them is going to be once a week having a small educational or knowledge piece. Probably be either a video or written up, about 10, maybe 15 minutes long, just short, to the point, about one subject sent out so that you guys can watch it as a video. It's pure skills oriented, sometimes around market conditions and things along those lines. But any thoughts that you have for those, I am taking notes right now and trying to get those down. So if you have a subject, now here's the criteria, so help me out on this. If you have a subject that is focused, like, a question that you'd like answered, something that you'd like to dig into a little bit, and it's something that's capable of being done in about a 10 to 15 minute video format, send them my way. I mean, I'll take a list right now if you want. And I I'm going to be doing some recordings of those. We'll be sending them out on a regular basis. We're also going to be doing a couple other content pieces during the week too. So, and we're trying to shift up how we're doing alerts and some of the trades. So hopefully everybody's going to be getting a little bit more stuff and some interesting ideas, some interesting things, and I'd like to make this a little bit better and more useful to everybody. So anybody have any thoughts at this point that they want me to write down, or do we want to kind of move on? Because I literally have a pen in my hand as I'm saying this. Shorting vol via VIX or VXX? Sure. I can definitely add that to the list. Yeah, and by the way, I'm going to keep asking probably for at least the next couple of weeks until I get a solid list of things that people want. But, you know, if while we're talking you come up with an idea too, please just say, add this to the list of topics to cover. Because it helps me a lot. Knowing what you want to hear, knowing what you want to, you know, get for information helps focus me on what I'm going to do, and actually bluntly makes my job easier. So and it creates something a little better for all of you. So you know, think about it two ways: one, doing me a favor, and two, getting something good for yourself. So all right, and Mark, I have that on my list: shorting vol VIX VXX. All right, couple things market wise. Let's see here. Market has moderately topped out. It really just kind of flattened out over the last week or two, couple of weeks here. Not surprising. This happens periodically. I mean, to be honest with you, if you look back in time, it happened back here. It happened essentially back here. Happened for a big, long period back here. What's going on right now is not terribly unique, special, anything like that. Doesn't tell us that the market's topped out. Doesn't tell us the market's going to crash. Doesn't tell us that it's going to rally. It just tells us that right now it's kind of regrouping and kind of getting a feel for what's going to happen next, which isn't really terribly surprising. We've had an amazingly long, strong bull run. We've got some, you know, we've got a lot of uncertainties sitting there in the market. There are a lot of questions about what's going to happen, you know, next, what's going to happen soon. Couple of things going on. I'm sure, you know, none of you have your head stuck in the sand. We have the healthcare issue going on with the Senate, whether or not they're going to approve their healthcare bill. Radically unpopular bill, but also very radically motivated Republicans, or a group of Republicans that want to get it passed. It will be interesting to see what happens with that. I'm not taking sides or picking one way or another, but, you know, that right there could have some kind of repercussions on where the market's going. We've got a break coming up, thank goodness. Personally, I certainly could use some breaks from news and politics. We have July 4th week coming up next. It's going to be a little break. The politicians are heading home for a while. Doesn't mean they're going to shut up, but maybe the stream of news will abate a little bit, and maybe we can focus on something like maybe family or having fun or something. That would be great. Other things driving the markets, we have earnings announcements going to be coming up fast and, you know, pretty strong here in another couple of weeks. We are about 2 weeks out from the beginning of the new earnings season, Q2 earnings season. And that one, I am personally at least very, very interested in seeing how that one all plays out. The right now, flat out, the market is excessively overpriced. It is very, very high valuations. In fact, I really need to show that to you. Give me 1 second here. Let me explain what I mean by this. Hold on a moment. All right, and I'm going to do this at a basic level. You can translate this concept into just about any measurement you want, but fundamental concept. When anybody is buying a stock, what are they buying? They're buying a portion of a company's assets, and they're buying the rights to future cash flow of that company. Now, so that means that when you spend X number of dollars on a share of stock, you want to get some good value from that. Everybody wants to get some good value. Now, there's two ways, hypothetically, you can get that good value. One is they pay out good, solid dividends based on what you paid in, and it's returning a very nice return based on dividends. Or two, the company could grow. Stock price could appreciate, and you could then sell the stock at a later date and make money. Pretty basic ideas. Now, it all comes down to what are you getting when you buy the stock? Portion of the company and future cash flow. Most of the time throughout history, we have looked at stocks from price to earnings ratio, or some form of an analysis like this. What is the price of the stock versus how much future earnings are you getting? And as the prices go up really, really fast, the P&E ratios get very, very high. Now, you can see that, well, this is actually going all the way back to the 1800s. I probably would discount things back too far. But there's been a long-term kind of valuation norm. People are willing to spend up to a little bit more than $20 per dollar of earnings on average. And sometimes it drops in difficult times down to $7, $8. Overall, if you look across this, the average P&E throughout this whole thing is about 14. Now, periodically, we've had some great big huge bumps leading into 2001 and the market correction. This was the dot-com boom when we were willing to pay pretty much any price whatsoever for a stock, no matter whether or not they had earnings or they were, doing anything good or not. We just bought stocks because, heck, it was different that time, and everything was going to go up forever, and the world was, going to be amazing. That ended. Then we had 2008. Now, I want to point something out about this. This big, huge blip right here, that right there is not a realistic number. Now, I don't want you thinking that this was some kind of realistic situation where in 2008 people were willing to pay, 100 times earnings. That was true, or 65, 70 times earnings. That was true, but it was mostly true because the fact that at that moment in time, the economy contracted so much during the 2008, economic crisis that almost every company was in negative earnings. So when you stick negative numbers in there, it messes things up. So please don't think of this as too much of a real representative number. I discount this whole thing. There was a period of a couple of quarters where the majority of the stocks in the S&P had 0 to negative earnings, which turned this into an outrageous number. Now, here we get into today. Before I dive into today, is there a reason why P&E ratios should be super high? Well, sometimes, yeah. It's perfectly rational to have P&E ratios high if we've got really strong outlook that we're going to have strong growth, good GDP growth, low inflation rates, excellent growth opportunities into the future, expanding markets around the world, and, future looks rosy, which is great. That would be a very justifiable reason to have high PE ratios. I would argue right now that I don't see that necessarily. I don't see the end of the world coming. It's not like we're going to fall flat on our face, but I don't see really, really high growth. We've got a bunch of headwinds out there. Now, and I'm not saying that we're going to go backwards. I'm not saying we're diving into a recession. I'm just saying it's going to be hard to be hitting. We are not going to get Reagan-era 4.5% GDP growth. It's just not going to happen. We have way too many baby boomers retiring. We're losing massive portions of our workforce. The economies that we were expanding into and growing into around the world, we've kind of saturated at this point. There's not a whole lot of new growth opportunities for new economies out there. wage growth is not picking up at this point in any significant real way. That would have been a nice boost to this whole thing. But, we've got a consumer base that's stagnating. In fact, I'd say that we probably have a demand side problem building up. Doesn't mean that we're going to be doing horrible. I think we're going to get reasonable GDP growth and all that stuff, but it doesn't justify P&E ratios up where we're at right now. Now, could they do tax code revisions and pump a lot more profits in these companies? Possible. Possible. Do I think the tax code could use a good kick in the butt? Yeah. Do I think it needs to be thoughtful and well planned? Yeah. Do I think the government's going to do that? No. There's way too many people who have their fingers in this. There's way too many people who have a need to protect this one little write-off, this one little thing. It's going to be extremely challenging to get good quality tax reform done. So, leaves us with this. Very, very high valuations. I want to see really good, strong earnings growth come into this next earnings season. We had good, solid earnings growth last earnings season. Excellent. Happy to see that. The majority of that number, though, when you look back at it, wasn't really across the board. It was just the energy sector coming out of dismal earnings and jumping way up to, better earnings. I mean, it didn't take much of a growth in that sector, and it creates a bunch of earnings growth. We're going to have harder and harder times to hit those numbers now, and just worrying that we're going to have some headwinds there. So anyhow, that's the backdrop that I just want to drop into the whole discussion right here. We are hitting some very, very high valuations. Does that mean that the market's going to crash tomorrow? And I've said this over and over and over. No, it's not a prediction that the market's going to crash tomorrow. What it is a prediction of is if and when things do start pulling back and reality starts taking hold, we have a much further distance to drop than we would have if valuations in the market were down at normal levels. To get from here down to one of these lower areas down here is a much bigger drop than a mid-level down to one of these lower areas. Could be a big shock in the market. Bonus things, though, pretty rare for bear markets to start in the summertime. So if anything, if we are going to see some kind of a stagnation pullback or something like that, I'm not saying it's impossible to happen in the summer, but it's rare for it to kick off in the summer. Usually things are a little quieter, more stagnant, things along those lines. So knock on wood, maybe we'll have a couple of months of nice stability here. Maybe we'll see some good progress economically and things like that. I'd love to see some great employment numbers. I'd love to see wage growth happening. Maybe we'll get some good, tax reform plans out there. All of those things would be wonderful. And big thing, let's see a great earnings season. But it really does need to be a great earnings season to even start justifying that number or chipping away at it. In fact, it has to be a great earnings season without the stock prices going up to start justifying that number. So we'll see what happens. A couple other floating around things. Actually, NL, how much of these P&E distorted from FANG names like Amazon and Google? That's one of the bizarre things right now. It's not, okay? This is where this bull market actually gets to be really bizarre. If you took a look at all the different sectors and broke down the sectors by their normal P&Es, because each sector really has kind of an average P&E for itself, every single sector has gone up across the board. We have things like, chicken producers with P&E ratios that are outrageous right now. I mean, for their sector. Tech and, things like Facebook, Amazon, Google, all of those guys, they have always had relatively high P&E ratios. And right now, it's not outrageously different from before. Within their own range, they're kind of doing what everyone else is doing. They're at the high end. But when you do that same comparison across every sector, we literally have the entire market has gone up in proportion with each other, which is very different from previous bubbles. Previous bubbles we've had have been one sector, the tech sector. internet boom, energy boom, the housing boom, the name the bubble, name the boom, and it was all very focused in one sector. This time, and I'm not saying this is good, bad, or otherwise. I honestly don't know what this means, but it's happened across everything. In fact, I would say one thing that I think is a little bit driving this, and this is interest rates. Interest rates have been so low for so long that people who want to do super low risk investing, the sovereign wealth people, the foundation funds, the pension funds, things like that, who want to dedicate a large portion of their portfolios towards wealth preservation, have been forced out of things like treasury notes, sovereign bonds, things along those lines, because they're paying less than inflation. They would actually be losing money if they put money into those assets. That has forced them to find ways to make money, and it's forced a lot of that money into the stock market. And a lot of that has gone into very, very boring stuff, your consumer staples, your boring, your consistent boring things along those lines. And that has pumped up the market quite a bit. Now, I personally think that the market's going to be moderately flat to slightly bullish over the next 2 to 3 months. There you go. That's my short-term prediction. But my risk ranking here of what would happen if things pull back is getting higher and higher. And I think that, we're digging ourselves deeper and deeper into a hole. So just keep an eye out, be careful, protect yourself, focus on maintaining a decent hedge and going from there. Can you guys hear me? Because I'm getting a little warning that GoToMeeting. Can you guys hear me now? Anybody there? Jesus. Sorry about that. I don't know what's going on, but GoToMeeting just told me that I had disconnected for some reason, and I don't know what's up. So sorry about that. Hopefully we're all good at this point. All right, Mark, equities are expensive, but I can't help wonder if there's a sell-off with the money. Where would the money go? Bond yields are low, uncertainty in Europe because of Brexit and Greece, real estate, traditional safe haven equities, Illinois. I certainly hope they don't go to Illinois or Venezuela bonds. I think that's probably more inappropriate than the stock market is. Mark, this is the way I would look at it, and I think it's a general model that most people in the market use when they're discussing this. It's not like all of that money will instantly go someplace, but as we have a couple of things going on, specifically top level items that are going to drive this is what does the Fed do with the interest rates? And second is what does the Fed do with its assets? I mean, the Fed is now holding on to something like $4.3 trillion worth of mortgage-backed securities, treasury notes, and things like that it bought up during the quantitative easing program. It has to liquidate those. As it liquidates those, it drives the price of them down, the face value of them down. The yields are actually increasing because of that. Now, increasing interest rates and pressuring the price of the treasury notes and honestly, it has a ripple effect throughout the entire interest rate market. Straight across corporate bonds, straight across munis, straight across sovereign bonds, everything. It has a ripple effect throughout the whole process. As the yields on those increase, they're going to get to a point where they exceed inflation, and they're going to be becoming more and more attractive to basically all of these investors. So it's not that it's going to instantaneously change. It's going to siphon the money off. That's the big thing. Not to check again, but you guys can hear me at this point, right? Because I'm seeing red on my connection here. Okay, good. Do me a favor, everybody. I'm just going to ask you today, because this is a really weird internet connection. Just ping me once in a while. Keep talking on your end. I like that anyhow, and it just lets me know that I haven't lost you. Yeah. So Mark and everybody else, did you get the general idea? It's not so much that it's going to be a snap your fingers and suddenly all that money leaves. It's going to be that as the interest rates go up across the board, it's going to be more attractive to take portions of that low-risk portfolio out and put them into treasury notes and things along those lines. And it's going to start siphoning money off from the market potentially. If other money doesn't come into the market to balance that effect off, well, they have to sell stocks to get the money out. It could have downward pressure on the markets. Remember, Mark, that most of the people that we're talking about when we're talking about this issue do not have the same motivation you and I have in their trading. All right, they are looking for basically barely making a bit more than inflation and doing it in the safest, most controlled way possible. A lot of that shifts back into the U.S. Treasury notes. Some of them would go into, say, European bonds or European Treasury notes. Some of them may get balanced out around the world in some more risky stuff, but in a more diversified portfolio of risky things. But these people are not, these people are not day traders. They're not even trying to, trade for their own retirement portfolios. They're trying to stabilize a fund of money to make a little bit over inflation over a long period of time in an extremely controlled, managed way. So very different thought process there. And it doesn't take much of that money moving to really hurt the market. So just some things to think about. Anybody have some questions? Any thoughts or anything? And Mark, does that kind of make sense? Do you understand where I'm going with that? And once again, this is more of a big picture, long-term, just kind of keep prepared in your mind about what's going on type of a view. This isn't predicting the end of the world tomorrow. And that's not what my goal is. My goal is to be aware of what are the risks out there, what can drive things around. We want to trade on what we've got in front of us, make as much money as we can off of that, but at the same time have a big picture view where we're controlling our risk and managing our overall positions. Any thoughts on the commodity cycle at the end of the year? And oh, wow, you're hitting me with one from left field. You know what? Before I just give you a random opinion that probably isn't founded in any kind of solid facts, I am going to pass on that issue, but I'm certainly willing to dig into it a bit. I know what you're talking about. It's just I'm not sure that I'm educated enough on the topic to give you any kind of opinion that would be helpful. So I'm just going to be fair and say I don't know. I'd rather tell you I don't know it than give you bullshit. Okay, let's move on. Hey, Sandeep, how's it going? All right. As far as the market's concerned, a couple of things happening right now. We've got a handful of earnings this week. I am going to poke around at Nike today. I tried doing a Micron trade earlier today, working through it. Just hit the wall, did not turn into a decent trade. So I'm moving on from that. but Nike actually looked, was it Nike? I'll have to double check that. I believe it was Nike. Looked pretty decent. Something we might be able to play with. Next week is the week of July 4th, holiday week. I will be here on Wednesday, so no real changes for me. But trading is going to be very, very thin out there. A couple of things to be aware of during the summertime. Bid-ask spreads tend to be a bit wider. Entry into trades is more of a pain in the butt. Slower, and you can get more slippage. There are times when you just won't find good quality liquidity out there, especially considering we've got such a low implied volatility. The VIX is once again dipping down to absurdly low levels. Where are we at right now? VIX is, wow, 9.97. Whew, that is outrageously, stupidly low. So be prepared that we are going to have some liquidity challenges. A couple of things to realize about the stock market. All the really, really big players, this is the time of year they're going on vacation. And they leave the office, the hedge fund managers, the mutual fund managers, they leave the office, they head out to the Hamptons, they head out to Newport, they do whatever they're going to do, fly off to wherever. And they leave the junior guys in charge and they tell them, don't touch the buttons. Except for if this happens, or this happens, I want you to liquidate our risk over here, dump this risk over here, whatever. That's the style of situation that they're left with. So a lot of times you don't have many huge driving moves in the middle of the summer. But the flip side of that is liquidity is also so low, and the kind of decision-making process is stuck in a very mechanical process that if you do have some kind of shock to the system, you can get pretty big swings. There's a couple things to watch out for on that. I don't want to make this a complete generalization, but during the summertime, sometimes those big swing days, 1.5%, almost 1.8, almost 2%, something like that, they're very often followed up with, within a day or two, a little bit of a rebound back. And this is, mentally you can think of this as the junior guys did what they were told, liquidated the positions, then the senior guy calls in from his place out in the Hamptons and says, what the heck did you just do? Why did you get out of these things? Get us back in. It's not uncommon to see a couple of those float around during the summer. They're typically not the beginning of the big crashes or corrections, but they could be. Be careful of kind of whipsaw days. Now, you guys have done a bunch of volatility trades with me before. If you catch it right, yeah, market's crazy, went down and it's up big time today. I don't know if I'd say up big time. We're still, 1%. I mean, we're actually kind of weird right now because we think of 1% as a big move. I remember when 1% moves were pretty much common. Things have been pretty moderate lately. Now, I'm just going to toss something out there to keep an eye on. And I can't really turn this into a trade, so I'm going to make this really quick. But I'm going to hand you a trade that you can do that is a really interesting short-term trade that you have to be on top of the market to take if you're going to take it. So here's the setup for the trade. Here we are in the middle of the summer. It is one of those days, and then suddenly out of the blue, some kind of news or something comes out on a stock, I don't know, or the market. Doesn't really matter. If it's a stock, you suddenly have this big move. Now, if it's an individual stock, you might have a 2, 3, 4, 5% drop in the stock all of a sudden. Now, it's hard for me to teach this because we don't have anything to work from, but let me see. I might actually be able to go and show you this on Amazon itself. 6.8. All right. Now, on 6/8, we had that big kind of flash crashy type of situation on Amazon. And actually on a bunch of different things. Now, no, it's not going to show up this way. On that day, does everybody, that was a Friday, does everybody kind of remember, anybody here remember trading that day? If you hadn't been paying attention on that day, in fact, next time you see this situation, pay very, very close attention to this. Take a look and watch the implied volatilities on whatever stock is going weird and crazy. Now, you got to use a little bit of a filter here. This is not something you do when a stock just announces that it had accounting fraud and may be delisted. This is something you do when there's a kind of really weird effect, like a flash crash type of a thing that takes a normally great stock and just whips it around. First thing you'll see during that process is implied volatility on the near-term options starts to jump up very, very high. So instead of 18%, if I remember correctly, intraday we were seeing something like 30-35% implied volatility on the near-term options. Now, by that I mean the options that are expiring in a week, maybe two. Those are the ones that are getting hit with a massive surge in IV while the situation is happening. Now, if you go out further, you'll notice that at that same moment, maybe a little bit of implied volatility is going into, say, the 30-day or the 35 or 40-day options, but not much. So for those of you who have done earnings trades with me, what you just have at that moment is a very interesting version of the same concept as the earnings trade. You would go in and you would set up a moderately narrow, nothing too wide, nothing too narrow, just kind of a mid-level trade. I'd say use something around a 35 to a 40 delta on each of the strikes. So in this case, I'd be setting up a dual calendar. Let me just show you what I mean by this. If I can get to the at the monies, there we go. I'm looking for a delta somewhere around, at that time, somewhere around 35 to maybe 40. So in this case, I'll just use 1,250. I'm going to take those short. I'm using that spike in implied volatility on the short-term options to sell those options at a very, very high price. Remember, everybody is scrambling at this point in the market to figure out what's going on. People are selling implied volatility very, very high. Prices of the options very, very high on those short-term options. So flip over and try to find roughly the same delta on the other side. And here we go, 117.50. All right, let me get rid of these. Now, you got to kind of think this through, but what I just did is I sold volatility, and at that moment in time, when the chaos is happening, these IVs will be jacked way, way up, 35, maybe 40% implied volatility. People are reacting, and the people selling options are backing way away from the market, getting their prices way up. The people buying options who desperately want to have some kind of protection for their portfolios are willing to pay huge amounts of money, and they're all focused on these very short-term options. So we jump in, and we create a short strangle. 1,250, 1,017.50. Once again, I use basically a target of between 35 and 40 for the delta on both sides. Then flip around, look for something about 30 days out. What you want to find is where it's far enough out, the implied volatility is, once again, just like earnings, kind of flattening out. Take those exact same strikes. Let's see, and go long. Okay. Now, what this just did is we did an arbitrage or a pairs trade basically between the long-term volatility, which is low, and the short-term volatility that's high. It generates a ton of credit on our side, and it creates a dual calendar that's pretty wide. Now, what's going to happen next, and how are you going to make money on this? Implied volatility is going to do one of two things. after the shock wears off, most likely the implied volatility of the short-term options is going to drop. That's going to make you money on the shorts. And if the shock was justified, implied volatility on the long options is going to go up. Between the two, you can actually make a really nice little trade out of it. Now, I just wanted to give you a heads up for that because it's a trade that I can't do flying through a class like this unless it happens to happen right in the middle of the class. But I think enough of you are advanced enough that you understand the basic concepts of what I'm doing there to work with it. It's a short-term trade, probably 2 days, 3 days between when you put it on and when you take it off. You're using relatively short-term options, usually a week, maybe a little bit more, as your shorts, and creating a dual calendar. Oops, that's actually on the historical things, but that does show you the concept of it. All right. Sandeep, it doesn't matter if we're in the summer. Yes, we can have the market move up. There's nothing about the summer that says the market's not going to move up. I'm just saying that the markets are going to be traded thinly, which is a very, very different thing from picking a direction. Means that we probably won't have much, huge momentum unless there's a shock. All right. Now, once again, I just wanted to introduce you to the concept of that shock type of a trade, just in case it happens to pop up. It's an incredibly hard trade to do as an alert because honestly, you have to be watching the market and seeing it happen. The trade could exist for 20, 30 minutes, an hour, maybe 2 hours, and then go away. So if I try to do an alert on it, 2/3 of the people out there miss it, and it ends up being frustrating. But before I jump into some of the other trades today, does anybody have any questions on that basic concept or an idea? Just want to prep your head for it because if you see it, and we're coming into the season where you could see it, it's a great opportunity. I've seen people, actually had a person I was working with a couple of weeks ago who took the Amazon trade and sent me a message the other day. It was a thank you. I don't get those too often. But he'd made $7,500 in about 3 days on that trade, basically doing what I just described. So Jim, you're selling the vol, but you're creating a dual calendar. You're basically creating a very, a little bit wider range so that you're not susceptible to big swings in the price. You're selling the short-term volatility, which is going to be high, very, very, very high. You take the same strikes, and you need to protect yourself. You can't just do a short strangle because, number one, the price of the trade would be outrageous. Number two, the risks of the trade, if things blew up, would be outrageous. Very, very bad structure of a trade. So we need to turn it into something we can work with. So we go out a few weeks, usually about 30 days or so, and we buy the same option strikes long. Now, those are going to have a much lower implied volatility. If they started out at 17, 18% in normal volatility situations, they might have added 1 or 2% from the event itself. The shorter term ones are going to have a massive change. Maybe they've started out at 17, 18% and they jumped up to 35%. So we sell the very high priced options and we buy the low priced options. And we wait for just a couple of days. A couple of things are happening there. One, because the very high-priced options, the high IV options, have a massive amount of theta erosion because they're, number one, short-term, and number two, very, very high IV. You're capturing money very quickly out of those. So there's one advantage to you. You're going to lose a little bit of money on your longs, but not too much. So the theta erosion and implied volatility dropping should make you money on the shorts. If the risk is real, and things are still moving around quite a bit, the implied volatility will then shift out in time across the expirations and cause the implied volatility of the longs to go up, which is way number two that you can actually make very, very good money on the trade. Because those long options, it takes time for that implied volatility to move out to those later dates. But those long options will go up in value a lot. So you're looking for that situation where you can create that. I would normally be looking to make, 30% return maybe 40% return over 3-4 days on a trade like that. Try to keep it moderately conservative, put a profit target out that you can work with, and just be careful that the stock is not moving around radically. Point of entry is where the stock settles down a bit. No, actually the point of entry, yeah, you can wait for the stock to settle down a bit. You don't want to do it when the stock is literally ripping around, but you don't want to wait long after that. Once again, this is the reason it's hard. I'm just going to teach the concepts because it's really hard for me to do this as an alert. Unless we had one of these situations happen literally in front of our face during this class, I couldn't get the trade on, get the alert out, get the information out to everybody in time for everyone to take the trade without 2/3 of the people being pissed at me because they missed the opportunity. So what I'm trying to do is just make you aware of the trade and the situation. And you know, if you've got good experience in these types of trades, like earnings trades, which are very similar, you can use that same set of concepts to make the trade work for you. So as I said, I just wanted to introduce the concept because we are getting into a time when I hope that some of you can use that to make some good money. They're quick, you know, they're literally almost a couple days long, very profitable trades, all based on the fact that fear, uncertainty, and doubt just explodes when you have that sudden shock to the symbol. And does anybody have any questions on this before I move on here? Yep, it is a dual calendar idea. That's exactly what it is. In fact, hold on, I didn't realize that I was in Think Back when I set that up. Let me just do it really quick. This is what the trade would look like, although not exactly. So let's see, I'm looking at 965 short. $10.07 short. Okay, so that was a short-term option. I'm going to use the same options long-term. I've got a 965 and a 1007. Now, realize that this right here is not the situation. So I'm just showing you the structure of the trade or what it looks like. Yeah, well, this is definitely not the situation. What you would see is a traditional iron condor with a dual calendar with a very, very high level of profit in here. And it would have a very, a decent wide area over which it would work. And the changes in implied volatility are going to drive that trade. This is a very bad example. Please don't look at this one. I was just hoping to show you the basic outline of the trade itself. You want the short options to be usually about a week in the future. We're not holding this trade very long. You want them to be the options that have a very, very high implied volatility that's been created from that sudden price movement. And then you want to go out. My typical range is about 30 days, maybe a little bit more. You want to go far enough out that those options haven't seen a major change in implied volatility, and you're playing the difference between the two. So, anybody else? Quick little idea concept there. If I see one of these, I'll definitely hand them to you. I just, I know for a fact that it's really hard for me to do them as alerts. But they're the candy out there when you do see them. All right. On that note, let's shift over. Let's just cover a couple of the open trades, and we will go from there. By the way, if anybody wants to have a chance to go over a deep fundamentals education, in the next couple of weeks, we're going to be marketing a lab, a fundamentals lab and a tactics lab that's going to be coming up in the not too distant future here at T3. So keep an eye out for that. I'm sure you'll get some information on that, but would love to see some of you join me in that lab. It's a pure education lab as opposed to these where we're doing a lot of trades. In that we're actually learning the fundamentals of the Greeks, how the different trades work, how the different strategies work. We'll go over all the different volatility models, the way that trades are affected by volatility, by price changes, time changes, all of those things. So love to see some of you there. All right, trades-wise, Google. We have a pretty straightforward bull put spread, 895 by 900. We got 15 of these things. Right now, Google is up at 954, despite its being smacked around a little bit by the European Union. It's actually bouncing back up a little bit. If we get a little bit more of a run-up, I'm really looking forward to shutting this trade down early, but for right now, it's doing fine. It's safe. We didn't get hurt all that much from the European Union's fine. Overall, looking okay. IWM, this is a Russell 2000 Iron Condor. This has a very, very long-term time frame. We're looking out at expirations around September 15th. Primary thing I want to see, and we're edging up to it so close, is I want to see these puts, the 120 by 123, get down to about 10 cents. Currently, they are just outside of that. In fact, they're at 12 cents. What I want to do is I want to close these out. That will lock in a nice solid credit on that side of the trade. And from that point, I want to be looking for a moment when the market does a bit of a pullback. Ideally, implied volatility goes up a little bit, and we re-enter these. Now, I don't want to just immediately turn around and do that, because what will happen is that we're going to be putting those on in a very, very low IV situation. The strikes will be very close to the current price of the market. I want to wait for a little bit of a pullback. Now, we are sitting here at 142. I want to pay attention we're not getting too close to 148. So there is a little bit of risk there, but that's the general game plan. And we are getting really close to executing on that put side. So fingers crossed, we'll be there soon. NVIDIA. This one is a 140 by 155 back ratio spread. So let me show you this one just a little bit. Okay. Now, a couple of motivations for this trade right here. One, I think that there's a decent chance NVIDIA is going to be heading up, and we are going to be making some money. NVIDIA has been extremely strong, and there's a lot of good reasons why NVIDIA should be going up. But there's also the very big risk that NVIDIA could pull back quite sharply. I think if it does pull back, it's probably not going to waffle too much. It's going to drop. We could see a retracement down here to 130, 120, something like that. Back ratio spread gives us some really interesting control over the trade. It has some downsides. It's not all perfect, but what it does is it creates, in the early life of the trade, it creates an area where we've got very, very limited and controlled risks. Now, if NVIDIA drops all of a sudden, implied volatility will actually increase. It'll help this whole thing. We could actually see a decent little profit down here. If NVIDIA continues to go up the way it is, then we are going to see a greater and greater profit here, and also time erosion will help us up here. Now, biggest enemy we have in this trade is indecisiveness and NVIDIA just kind of waffling around, and worst case, dropping down a little bit, say mid 140 range or even 140 itself, and theta erosion pushing this intermediate P&L down. It's going to create a greater and greater risk for us in the middle here. The worst case is a slow drift down towards that, so we want to be paying attention. We have a reasonable amount of time to play with this. I would say that sometime between July 7th and July 14th or so, we would want to make a strong evaluation of the trade. Is NVIDIA up here ideally close to the 155 or maybe a little above range? Do we feel like NVIDIA is going to be solidly up in that range? In that case, we'll leave it on until the 21st and let it expire for a nice little profit. If it's not, and we feel like there's a big risk that it could pull back and hit a much worse situation down here, let me show you this, by the way. As time passes, that valley of death down here gets deeper and deeper. So the risk of NVIDIA pulling back and moving into this becomes higher. Right now, we've got very little risk down there. Can't hurt us very much. But later on, it could. So we need to evaluate, do we want to stay in the trade? So judgment call somewhere between the 7th and 14th of July. For right now, I'm fine with this. I would like to see NVIDIA, pushing back up a little bit. It doesn't really have too far to go before we're in a really nice spot in this trade. So fingers crossed, looking forward to that. SPY. Anybody have any questions on these things as I go? Feel free to just toss questions out. SPY, very similar trade to what I did on NVIDIA. This is a back ratio spread on spiders. It is a 238.50 put. Oh, by the way, back ratio spread, all it is a very, very aggressive, moderately wide bull put spread. So you can see 238.50 by 245.50. And if I had 10 short on the puts and then 10 long on the puts, that would just be a bull put spread. But I took some of that money from a very, very aggressive bull put spread and invested it into a long put, which ends up being my protection in the trade. That's what gives us that back ratio spread kind of layout on the trade. Right now we're about flat. Theory and analysis is effectively almost the same thing as what I just said on, there we go, what I just said on the NVIDIA trade. We have a little less time on this one. I would say that in the next week or so, if we've not seen a moderately decent move up, and I'd like to see SPY getting close to 245.50. So right now we're at 243.64. It's not a huge distance to go. As a matter of fact, let's see. Where are we at? 243.64. That is only 0.7% gain to get us there. Anything beyond that is bonus. I'd really like to see us up at that 245.50 range within the end, over the next week or so at the most. If we're not there, or if we start pulling back, we'll just close this trade out to basically mitigate the risk and walk away from it. So we are basically playing this bearish. On the other hand, if the market does do a real big drop, we're going to see implied volatility move in, and we're going to see a large movement down. I may hold it to actually make the money on the downside. But for right now, my major goal is to have SPY moving up towards 245.50, which is really reasonable, to be honest. It would be a new high, but even approaching that would help us. So, all right, last one. VXX, this is purely a hedge. This is designed to not even make us money. It's designed to protect us in case things blow up in our face. We put this on. We've got 23 days left on it. It's a highly leveraged, very aggressive bull call spread. 17 by 20 bull call. We've got 22 of these. We paid very little for this. When and if the market goes into a correction, we will get probably about a 10-to-1 payout on this. I believe this one's designed to net us somewhere in the area of about $4,000 to $5,000 in profits if the market goes into a correction or a crash. Other than that, we spent a small amount of money to protect our portfolio. That's what it's there for. It's doing its job. There's no way to lose a big chunk of money on this, and the probability of winning a big chunk is very small. But if we do win on this, it's going to be a great thing to offset losses in a lot of other trades. So that's why this trade exists. Okay, any questions on the portfolio in general? Thoughts, ideas? Nope. Okay. Everybody good? Sandeep, if SPY stays between 238 and 243, then we lose as time goes by. Best thing to do on that is just look at the analysis. Theoretically, if we left this trade on, let's assume it stayed at 243.63, and we left this trade on till the expiration, which is the blue line right here. This trade right here would lose, well, it's actually be almost break even at that point. It's, hold on. No, it would be a little bit down. Let's see, the 14th. There you go. If it stayed right where it is, 243.58, we would lose $470 if we left this on all the way to the expiration on the 14th. Now, if we had the stock go down, let's say went down to 243, we would lose a little bit more. We'd lose about $1,000. If it goes up really much at all, we're immediately moving into a profit zone. So it's a little bit of a trade-off there. If this trade was sitting here a week from now, right where it is, we would be getting out of this trade. I wouldn't be leaving it on. You know, we wouldn't have seen the movement in the stock. You know, SPY wouldn't have been going up. It wouldn't have been, you know, it wouldn't have been doing what we wanted it to do. The criteria for the trade would have basically failed. So there's no reason to leave it on. I'd say we'd be taking it off beforehand. So that's basically what's going on with this one. We're not in a high risk situation with this at all right now. It's pretty kind of normal. It's moderate risk at this point. But as time goes on, this dip, the valley of death, does get more dangerous. So we do want to be more aware of what could happen if things pulled back. All right, let's see. Please show VXX again. Sure, Michelle. Okay, the VXX trade that we've got on, I would have to go back to figure out when I put this on. It's been on there for a little while. Is a very simple 17 by 20 bull call spread. That means it's a debit spread. The cost of the trade is going to be a fixed amount, and that amount is the max loss you can have in this trade. It's a very small amount. We only did 22 of these. When we got into this, the cost was, let's see, 52 by 34, so 18 cents. Let's just run some of the numbers real quick. So it cost us, it's a $3 spread, difference is $3, minus the 18 cents that it cost us. Max profit we could make on this is $2.82. In reality, we're not going to hit a max profit, but we could probably hit about 80% of that. So we can make $2.25 off of the 18 cents we invested in this. I'm just roughing it now. So that would be a return on investment of about 1,250%. Now, the only way we're going to get that, and realistically the only way we're going to get that, is if the market does a big crash. So that's what this is for. It's a hedge against a crash. We've got 23 days left in the life of this. Let's see, we invested, let's see, $18 times 22, $396, so that's the max we could lose on this. I consider that just purely an insurance premium, just to make sure that I don't blow up my portfolio. So that's basically the outline of this trade. Game plan on this trade is we wait for, you know, if and when the market does that big move down or the big crash, number one priority, close and control all the high risk trades in your portfolio. So if you've got a bunch of things that would go horribly bad during that type of a situation, number one goal is to close those out, get the risks off the table. Second, you take a look at all the trades that weren't necessarily at risk. Some of them bearish trades, others long volatility that are making some money. Focus on those. What are you going to do with them? Most of them, I would suggest close them out and walk away. Finally, once your portfolio is 100% completely under control, you flip over to this trade. VXX should have shot way up. We've got a very nice profit in this trade. You close it, you take the profit. That profit should offset the losses you received in some of your other trades and minimize the overall effect of the crash. Basically leaving you with money in your pocket to dust yourself off and trade tomorrow, which if you're in the middle of a big crash, look for volatility. Lots of opportunity to short volatility at that point, and look to make some money. All right. Rob, SLB bear put calendar with earnings. Let me just double check something, but I don't believe I got a fill on that one, which was the problem. Hold on here. No? Wow. That's not the problem. Good catch on that one. Thank you. Thank you, Rob. Where did that go? All right. I've been having a lot of frustration with Thinkorswim's platform lately. So let me just set that up. This is a 100 contracts, SLB, 14 shorting the July 14th 63 put, going long the July 28th 63 put. Let's take a look at this one, and thank you for catching that. In my rush to get through things, I didn't notice that that wasn't there, which I need to find out why it isn't there now. So yeah, I technically I got filled on that. I'm not going to claim I didn't get filled. That's not right. It was a trade. Rob is right. It's on my fault on this platform. Didn't keep it where it was supposed to, or either that or I messed it up somehow. So let me reset this trade up so that we can see it clearly, and let me put it in there, and let's take a look at that. And thank you, Rob, because that isn't right. Okay, 63 put. And a 728, 63 put. Long. And we got into this for a 43-cent debit. Okay, so let's take a look at SLB. Right now, it is heading down in the right direction. We are approaching the earnings announcement. P&L wise, we're at 40 cents on that trade. When we got into it at 43, we're fine on that. I don't see any issues with that. Overall, I'd say the trade is heading in the right direction, although we do need the implied volatility in the long to move up a bit, and it would be nice to get Schlumberger to move down towards 63 a little bit more. Analysis-wise, this is where we look at right now. Slightly down, not a big deal. I'm going to have to fix this trade up in my system so we have better tracking of what's going on. We want Schlumberger to continue to move down, heading towards 63. The kind of wild card, or the ace in the hole that we have on this one is that implied volatility will be slightly moving up on the long options as time passes, because we're getting closer and closer to the earnings announcement. That should increase overall the value of the longs, which is good for us, adding profit. We should be in good shape. So right now, Schlumberger is hold it, maintain the trade. We're just going to manage it as it goes forward. That's basically it. Anybody have any questions on that one? Okay, so let's dive into some new stuff. Everybody good? Everything? Last final call questions across the board. Open table. Anybody needs anything clarified? Have a general question about anything overall? Where do, any thoughts? And Rob, you get bonus points for the day. That's okay. Sandeep, I don't see it. Yes, there is a chance that SLB could go up. I honestly, I don't see, right now SLB is in a very good, solid trend down. I'm not a technical analyst, so you may see something different. You're welcome to have a different opinion than me on this one, but in general, I see Schlumberger going down, and Halliburton has been in the same trend also. It's generally an industry trend. Could we get some little bumps between now and then? Sure. Could the trade fail for half a dozen different reasons? Sure. Do I think it's still a good trade based on a good idea? Yes. So I'm going to hold on to it. So that's basically where I'm going with this. But if you're uncomfortable with it, every single trade that you make or every decision you make is your own. Strongly support you making your own decisions and doing different things if that's what you believe is right. I'm not here to, I'm not handing down the word of God that you absolutely have to do. I'm giving you my thoughts, my opinions, and my perspectives, and setting up some trades that I think are good ideas. From that point on, use your brain. I respect you and should make your choices. All right. Other direction, UNH. Okay, what do we have on UNH? This one's an interesting one. United Healthcare. Interestingly enough, this was the most, let me see how to say this, had the most analyst bullish ratings and changed to bullish ratings out of any stock in the S&P 500 over the last 3 months. Interesting little report put out by FactSet, which broke down things. So I decided to dig into this and take a look at it. Sandeep, I did take that SLB trade. Okay, so I'm not bowing out of the trade in any way. It's mine. I own it. So I did take it. If you didn't, that's fine. But I did take it. I did send an alert on it on June 21st. The alert is literally right there. So win, lose, or draw, I'm owning it. That is the trade. If you didn't take it, that's fine. Once again, not forcing you to take anything. All right, UNH. Basically, we have one of the strongest, most, pushed symbols out there. It is in the healthcare industry, which is, I think, a little bit of a risk right now because of the healthcare bill that's going on in the Senate. We'll see how that all plays out. But in general, we've got one of the strongest players on a very, very strong bullish trend. Now, question is, do I think that this trend could continue for at least another couple of weeks? We have a couple of things that we can play with in this one if we think that's the case. Now, first thing I wanted to check is to make sure that if we were to take just a reasonable length trade, do we have some options that we could play with? Not bad, not outstanding, but not bad. The idea that we would be working with is this. We have an earnings announcement on the 18th. We should see a moderate, by the way, this one doesn't get huge rises in implied volatility, but we should see a moderate rise in implied volatility and combine that with a bull call spread, or excuse me, a bull call calendar spread. We could set up a trade that basically has a good solid chance of making some decent money. Flip side of it is, if that trade, which would have a strike set up here, if that trade were to fail, it's likely to pump a decent amount of extra implied volatility into the options, which would help protect us in case the trade goes against us. So we've got a couple of possibilities of how the trade could play out there. If there's enough implied volatility in here, we may even be able to turn this into something along the lines of a diagonal, which would give us little to no risk on the downside and still leave us with a reasonable, solid profit on the upside. So let's play around with this and see what's going on with that. Humana, yeah, take a look at that. There we go. Actually, you know what, Mitch, that might be even a better opportunity. The reason I'm saying that is that it's a dividend. Where are the earnings? I'm curious to see how much implied volatility change that Humana gets going into its earnings announcement. But $240, the price on this is $240, makes it a real easy trade to work with. That one might be a very good one. I might poke around with that one also. So let me see here. Okay, we could do this one for a longer period of time. The earnings announcement is on August 2nd. So we basically have two of them to play with. And I don't know if you guys can hear that, but I got a nice thunderstorm rumbling by outside. So just heads up, if I go away, in the past I've had internet go out periodically if we have a big lightning strike here. So I'll try to jump back on just as quick as possible. Okay, UNH. General concept here, shorting an option that expires before the 18th, going long an option that expires after the 18th. Where would that put us in the time? So we would be looking at the 14th of July as our short option, and we would be looking at the 21st of July as our long. You can already see a little bit of a divergence in implied volatilities. This is all about the upcoming earnings announcement. Now, in a few minutes, we're going to double check and see what it's likely to rise to. That'll be a big part of this trade. But the market is already starting to price in some of the volatility from the earnings announcement. That's can be good or bad. We don't want it to get too out of hand, but it's good to see that the process is going. So first thing we need to do, figure out roughly where do we believe that United Healthcare will be on its way to the 14th. So let me just toss in a couple of little lines so we can get a sense of what's going on. There. Drop this down to a year so we can get a little better idea. And there. Now, what could happen? We don't have a huge amount of time. We've got a little over 2 weeks. UNH could pull back. We could see a little bit of volatility go in there, or it could basically move and continue on its trend. I don't know if I'd want to get overly aggressive on this trade. I don't think that I want to go to this crossing point up around 188, but we might go somewhere around 187, 186.50 or so, potentially even down a little bit lower. I probably wouldn't want to go too much lower. We want a point that has got a decent chance that the stock is going to touch it or pass through it over the next 2 weeks. And we're going to use the implied volatility change to our advantage also. So I'm going to start working at basically 187. It's below the high. It's not too far away. I think it's pretty reasonable that we can be hitting that. So the 14th. All right. I don't have many options in this one, so this may actually limit us on this trade. We're looking at 187.50, which is a little higher than what I wanted. Bid-ask spread 30 cents. It's not horrible on $185 stock. We can work with that. Let's just see if the trade itself makes sense. So I went short on the 14th at 187.50, and I'm going to go long on the 21st at 187.50. Now this should give us a debit. 128 debit. Let's take a look at what the trade looks like and see if it makes sense. Now, first of all, let's see, where are we right now? 185.36. So a couple of features I can point out right now. If implied volatility does not change at all, we are going to be inside the cone of profitability here. Just because of that, we have better than 50-50 odds on having this trade work out, because it could actually move against us or fail a little bit before we actually hit our break-even point at the expiration. Hold on, why are we into a profit right now? That's not right. Because implied volatility has already been adjusted. All right, hold on. Let me clean this out. There, that looks a little bit more. Okay, hold on. All right, so evaluating it now, that's why I was a little wondering a little bit about what was going on there. It's not quite as good right now. We've got a smaller peak profit, and we're basically at break even, but we would have to move up. So that means that we've got a little bit less than a 50-50 shot just from random market movement of winning this. The big question is, do we believe that the trend that UNH is on is going to give us an edge in this trade and make it a higher probability trade? And the second piece is, where do we believe that implied volatility is going to go on the long options? So, strangely enough, I already did some work on this one, evaluated that. All right, just going to do a quick little check on UNH. Last time UNH had an earnings announcement, April 18th. And I'm going to go to one before that also. I'm just going to do the last couple just to get a sense of where it is. All right. I'm going to put myself back in time and just see what did UNH do in a similar style of a trade back in April's earnings. So the earnings announcement was April 18th. That means we would have been exiting the trade on the 14th. The options that we care about the most are going to be the options that expire in a week past that. So April 21st, what is the implied volatility of those? So these options, this is the Friday before the earnings announcement, equivalent to when we would be getting out. The long options hit about 33, 36. Okay, something's weird with that. Hold on. Something's messed up with Thinkorswim's calculation on this. That's not right at all. All right, let me go test another one. 117. Earnings announcement on the 17th. We would have been exiting on the 13th. We want to know what the implied volatility is on the options that expire in 7 days. So 29, 30%, 28, 29. All right, that gives us a general idea in there. We're looking at about, say, 29% in general. We'll do one more, go back to October 18th. For looking at the Friday before, what are the options that expire afterwards? These are less. So about 25%, 25. All right, so we have one that's 29%, one that's 25%. And the first one that we tested out, I don't know what it is because that's just messed up. take a look at the trade. Currently, the implied volatility on the long option is 19%. So let's assume that we take the smaller of those two numbers. We have one sample where it goes up to 29%. We have another sample where it goes up to 25%. Let's just add 5.5% onto this option and see what happens. So that is the 21st of July option. All right, this is what we're looking at. So this is the trade effectively that we need to evaluate. As long as we stay 185.35, we're going to be making, well, on 10 of these, about $1,000, potentially up more. We can scale it, by the way, we can scale this trade up. Actually, need to put this in there. Okay, so about $400 at the expiration, going up to about $1,200 at the end. Now, this trade doesn't cost us much. It costs us $1,270. So this is almost 100% return in here. The 400 is, let's see. About a 30% return. So that would be if we were staying pretty much flat, stable where we're at. If we go up, we actually have a chance of making a lot more money. Implied volatility increasing is going to be a big effect on this trade. So here's the question. Do we like the overall setup? Do we want to protect ourselves to the downside while basically erasing some advantage to the upside? Do we like the trade as it is? Do we take it? There's lots of profitability in here. As long as implied volatility is heading somewhere close to 25 or above, we're looking really good on this trade overall. So do we believe UNH is going to be heading to the 187.50 range? What's the odds of that happening? Do we believe that the implied volatility is going to move in? That one I can give it a pretty solid answer, yes. Any movement up is going to basically be a nice little profit for us. So make some judgment calls. What do you guys think? Let's answer the first question. Do we believe that it is a pretty decent shot that UNH is going to be moving towards 187.50 between now and the 14th? Okay. Anybody else? Any other thoughts? Now, I want to point out one thing. If this were to suddenly drop, which would hurt us, we would also likely get a nice big jump in implied volatility at the same time, which would actually help out the trade. And it wouldn't necessarily make us not lose, but it would make us lose a lot slower and a lot less. So this is a nice trade because it's got some control over the risks. It would fail, I like to call it failing gracefully. So that's an advantage here too. Healthcare bill may affect it. I think if anything, the healthcare bill will potentially give it some volatility increases, which would be very helpful to us. The big question is, would the healthcare bill, let's see, let's walk through the scenarios in this one. Right now, it doesn't look like, well, flat out, they are not having a vote for the healthcare bill before July 4th. And it looks like it's going to take at least a little bit of time for them to rejigger the whole thing and try to sell it to the moderates or sell it to the Tea Party end of, what do they call themselves, Freedom Caucus end of the Republican Party at this point, and try to figure out some way to make the whole thing work. Now, my guess is that's going to take at least a little bit of time. Mitch McConnell or Senator McConnell, let's be respectful here, is very motivated to get this thing through and voted on and passed. Sometimes wonder if he just wants to get it voted on so that he can move on. So I think that they're going to try to be motivated on that and going to be pushing for that. I think the biggest effect on UNH would be a really surprising vote. I'm not entirely sure whether that would be a positive or a negative for them. I do think that United Healthcare is a little bit isolated from this because they're one of the strongest companies in the whole sector. and one of the most promoted, at least from the analyst side of things, companies in the whole sector. So it may have a little less effect on them. Now, one thing that definitely could be happening from this is a rise in implied volatility just over anticipation of this, of the healthcare vote. Now, that would actually be a helpful thing. Let's take a look at that. As implied volatility goes up, first of all, that won't work there. Let's say we got a little bit of extra implied volatility on this, just maybe an extra 2%. Every time implied volatility goes up, we're actually gaining extra profits. Now, implied volatility doesn't matter too much in the short-term options because those ones are going to be going close to expiration anyhow. So volatility changes at the expiration really won't affect that. Prior to that, though, we would have some potential, would have a little bit of a negative potential if volatility goes up on the short-term options. It's only if we exit early, though. But it's still not that bad. 2% increase in volatility on the longer-term options has a lot more positive effect in the trade than a 2% increase on the short options, which would hurt us. So the net between those two is still a net positive. So increase in volatility, increase in anxiety and fear, uncertainty and doubt would actually help this trade. Worst thing though, something comes along and UNH pulls back. Now, at that point, we would very likely be looking at a big jump in volatility across all of this. Now, our break-even point would actually be going down, but we still might move enough to move past it and lose some money. Likely, we will have to manage the risk of the trade at that point if something big enough in the healthcare vote causes UNH to drop rapidly. We have an alternative, just so that you know. We could do this. Hold on. We could tweak the trade just slightly. Oof, no, there's not going to be a just slightly tweak on this one just because of the strikes, but oh, come on. There. We could do this, but this comes with a risk, which I'm not sure I'm real excited about. The risk is this. Hold on, I need to clean these all out first. This is called the diagonal. We got rid of the risk on one side of the trade. We reduced the risk dramatically on this side. We pushed it all off to this side. The problem with the trade right here is that if we had UNH go up too fast, we would be in a losing situation right off the bat. And I'm not sure I'm excited about doing that. I think the trade I like more is more the standard calendar trade. So, all right. Like, don't like. Like. Decision on Tuesday? Tuesday is the 4th of July, and I'm pretty much going to guarantee that they're not going to, oops, sorry. Yeah, no, that's the 4th of July. I highly doubt they're going to do any kind of vote on that on the 4th of July. That's actually during Senate recess. So last time I heard, they've postponed the vote on that period, and they're going to rework it and then come back and settle on a new time for the vote. You need to give the whip a little time to rally, the votes and make sure everything's right. I would be surprised if they had the vote before the end of next week. That would be actually really surprising for me. My guess is it would probably be 2 weeks out at best, but I could be completely wrong on that. Yeah, but Sandeep, it's not like they're going to snap their fingers and just redo a vote. I mean, it literally does take some time to do this. They might be able to do it fast, but fast is like 4 days. My guess is we're about 2 weeks out from the earliest vote. I wouldn't be surprised at all to see a vote on this. I wouldn't be surprised to see a vote on this between the 10th and the 14th, and that is definitely a possibility. I strongly doubt that we're going to get a vote on the 5th, 6th, or 7th. I'm not even sure if they're back from their recess at that point. So maybe the 10th to the 14th. If somebody could check, how long is the Senate recess? When do they actually get back in session? Because that's when the clock will start ticking, and they've got to get, rally the final votes and set up the vote to happen, which needs a motion to continue, and it needs to be planned out a little bit. I'd give it 3 to 4 days to make that all happen. All right. Overall, I like the trade. Let's see what we can do with the trade. I'm just going to put a couple of basic controls in this one. Roughly a 40% stop loss is just, if anything causes me to lose that much, it's going bad anyhow. So let's figure out where that is. Oops. So that would be losing 52 cents. If we applied about $2,500 in risk capital to this, and we were controlling it at $52 each trade, so that would be about 48 of these. I'm just going to round it down to 45 and call it good. And there we go. So that would be the trade. We'd be doing 45 contracts of the July 21st 187.50 call long, 45 contracts short of the 14th of July 187.50 call short. We should be able to get into this somewhere around 130. Might add a few cents to get a faster fill on it. Goal to get out of this. Now, I think that we've got a relatively easy 30% target in there. We could go a little bit more aggressive if we wanted. I'd probably be putting somewhere between a 30 to 35% target in, which would put us at about 169, 170. So I would be building in a profit target. Let me lay this out. If you want to have a trade that's easier to hit the target, a higher probability of success, you go on the lower end of this. Or reduce this a little bit. If you want to make more money within reason, you can put a little higher target on that. I'm going to go for 170 at this point as my profit target, which would give us slightly over 30%. Once again, if you want to have a higher probability of getting out early and making a quicker, easier win, but take less of a profit, you can drop that number down, 160, 165, whatever suits your needs. If you want to be more aggressive, you can pump it up, 180, 185, 190, but realize that every time you put that number higher, then you've got to wait more time and there's less probability that the trade is going to hit that profit target. One of the limits that we have to have on this trade is that we have to be out of the trade completely, 100% by the 14th of July. Both of these contracts need to be gone. Otherwise, you're going to be left with a big chunk of long calls that are going to erode very, very rapidly going into their expiration. Theta erosion will kill you on that one. The trade works because of the balance between the two. So and okay, the order is out right now. It actually went out at 129. I might pump this up a couple of cents. I probably wouldn't want to chase this past 135 or so. Rob, by when do we want to exit this trade? Did I answer that for you a second ago? Here's the general guidelines that we're going to deal with on the trade. Stop loss is going to be, if we get filled on this at about 130, it is going to be at, hold on, $0.78 would be the stop loss. We would use a stop limit order on that, probably trigger it at about 80 cents and then put an order in, or 81 cents, put an order in to close at 78. profit target that I'm going to use is going to be 170. And as I said before, this trade needs to be completely closed and exited by the end of the day on July 14th. We could hold it right up to that point if we wanted to, especially if we're getting, if we're at a good point near near the strike we used. But we don't want to let the short option expire and leave the long option in, because at that point what you're doing is you're basically leaving the long option for a weekend, and that long option is going to have a massive amount of theta erosion because it's a very, very short-term option, and you can wipe out your profits very, very fast. I've seen a lot of people do that, and generally it's a bad idea. So just try to avoid that. We want to make sure that we're out of the trade by then. Okay. Any other questions? All right, let me get that one. It's going to take me a second to just get this sent out for everyone. So if anyone's got questions while I'm doing this work, fire away. I'm happy to answer anything you might want. Filled 129 instantly. That's great. Yeah, I got filled at 129 pretty quick also. So I wouldn't chase this. I wouldn't put a price too high then. In fact, you might even want to put a price, 127, 128, see if you can grab an extra few cents. It's always good to make the market come to you on these if you can. Okay. Yeah, filled at 128. Great. You're ahead of the game, Sandeep. That's awesome. Okay. So what did I say? Okay. I'm just saying this out loud as I type it, but our risk limit, we're going to use a stop limit that's triggered at, I'm going to use 81 cents. So that means that if the price of this trade hits 81 cents, it's going to issue a limit order to exit the trade with a price of 78 cents. So limitations of that and the benefits of that, it helps protect us, it helps control our risks. If the market is moving super, super fast or it gaps, then that limit order to exit may not be effective. Just keep that in mind. So you still do need to be paying attention. The thing that I'm trying to overcome is the fact that we really, really do not want to be using a stop loss order. Stop loss orders basically exit by issuing market orders get me out at any price I can get a fill at across all the legs of the trade is the most painful, expensive way you can exit a trade. And it often leads to losses that are way bigger than you ever wanted. So I try to avoid those. This stop limit order does not necessarily fix every problem, but it does help some. Profit target. Once again, I am putting in a profit target of using a good to cancel $1.70 limit order. So this will sit out in the market until it gets hit. Now, for the people who are smart about this, you do need to realize that you probably need to set up one cancels other orders. I'm going to leave that to you to sort out with your trading platform to do it. What that means is that if one of these exits or one of these gets filled, it cancels the other orders so that they go away. So this is a good to cancel $1.70 limit order to close. And this would be 30% profit. Okay, and there. All right. I think we're good. Good. All right. So you guys should see that alert coming to you in just a few moments. Let's see if we can nail one more and then probably call it good here. Been looking at a couple of different trades. Hold on. Actually, I'm going to open this up. The one I wanted to take a look at, one I was actually playing with, is Anadarko Petroleum. And I was playing around with this one in a couple of different ways. Actually doing a directed butterfly, kind of like a directed calendar trade. Also potentially using a calendar targeted trade for a bearish trade, like we've got a bullish trade on the United Healthcare, potentially using their earnings announcement. Although the earnings announcement doesn't do a heck of a lot to their implied volatility, so that may not be the most effective trade. That was one of the possibilities that I had on my list. Is anybody else? I saw a couple of people mentioning some others. Nike. There we go. Good call. Thank you on that one. Hold on. Trying to remember exactly which one it was, because Walgreen Boots was no good. Nike was good. Okay. Thank you for the reminder on that, because that was one of the ones I wanted to look at. Okay, so this one is a little bit of a different direction on the trades. This is still using the earnings announcement, but it's giving us a shorter term trade to play with. This one, effectively, we could be out of this tomorrow morning if we wanted. So if we're going to do this, let's get it knocked out. But stocks beaten down and breaking up big like CBI. You know, Luther, I tend to avoid stuff like that. Let's take a look at that, and then I'll jump back to Nike. Hold on here. Let's go a little wider. So, Luther, let me just give you a couple of thoughts that I'd have on this one. First of all, there may be something here from an implied volatility point of view, because right now their IV is absolutely outrageous. I would want to know why this happened. Now, here's the things that worry me about these situations. And in general, honestly, I don't take trades that look like this too often. This right here, this situation is just, in my mind, too unpredictable. It's something crazy is going on. I'd have to look into the, research the notes and the news stories and the rationale. We had a bunch of things happen here. First of all, Chicago Bridge and Iron, it's a decently traded stock. Nothing too exciting there, but it had a normal amount of volatility and a normal amount of volume. And then something happened right around this earnings announcement. And they've had amazingly high volume ever since, significantly high. Now, out of the blue, a couple months later, we seem to have this huge spike up. Right now, I don't know what's causing this. I don't know what's valid about it. I don't know if it's going to continue up or if it's going to fall back down. One thing I can say is that having an implied volatility up in the range it's at right now gives you, there's a lot of room to be paid to take some risks on that. That's an amazingly high IV. But a lot of times it's hard for me to pick out what's going to happen next. Now, the way I might look at this one is wait a little bit for things to settle some, just get past whatever's driving this, and then use the dropping volatility in a trade that gives me a really nice edge and lets me play it a little bit safer. But I tend to stay away from where the bomb just went off. Like to let the dust settle a little bit. Now, if you're good at picking the directions on those, that's great. There's certainly plenty of IV to work with there. Could be lots of potentials for trades. I just don't know what that's going to necessarily mean in the near term. So I'm going to pass on that one, but I'm going to keep an eye on it and see if that kind of settles down into a, kind of more narrow banded upward trend, sideways or down, and then also watch for volatility to drift off over time and maybe ride the volatility down once I have a comfort that this isn't going to do another $5, $10 gap. Yeah. So that's my thoughts about that. But they do represent opportunities. Just be very careful that you're not trying to predict what you think should happen in a very chaotic and uncertain circumstance. You want to be taking the side of the trade that might not be the perfect nailing every little penny, but you want to try to take the side of the trade that's a lot more consistent and predictable. And once it settles and IV starts drifting down, yeah, that could be a good one. Okay, back to Nike. Let's see if we can knock this one out, because if we're going to do it, we have to get it in before 4, and I want to get the alert out early enough so that people can play with it. Nike has its earnings announcement, I believe, tomorrow morning. Oh, no, it is aftermarket. That's interesting. Hold on. Okay, that changes the trade a little bit. Let me just double check something. We need to know whether or not Nike, actually, if somebody could do me a favor, check a good reputable source and find out, is Nike doing its earnings announcement tomorrow night or is it doing it tomorrow morning? Pre-market or post-market? I need to know that. I'm going to take the other part of this, which is doing a little bit of research. So Nike had an earnings announcement on 3/21. $12.20. $9.27. $6.28. After close tomorrow. Earnings was super. Thank you very much. Okay, thanks guys. Appreciate that. That makes my job a lot easier. So 3/22. So this trade does look like it's going to happen tomorrow night. The event is going to happen tomorrow night. So it's just going to change our management of this just slightly. Not a big deal in any way. Oh, there is a big deal here. Okay. I've actually got a little bit of a personal conflict on this one. So let me lay this out for you. On Friday, I have a doctor's appointment that is going to take up a good chunk of the day, from the morning until basically into the afternoon. This trade is going to be something that everybody needs to deal with and close out on probably Friday morning between about 9:30 and 10:30. Now, I can lay out all the details of exactly how to do that. We can set out a profit target. I can do a bunch of different things. But I am not going to be here to send out the alert to do this, which creates a little bit of a problem. And there is physically no way I'm going to be here to do this because at that moment in time, I'm probably going to be a little out of it. So here's the question. Do we want to go ahead and do this? Understanding clearly that I am not going to be able to send the alert, but I can give you a layout of exactly what your decisions need to be at that moment. Or do we want to move on and do something different? I'm going to give you guys who are in the room right now get to make the choice on this one. Everybody else just gets to ride along. Let's try it. Okay. All right. I'll give you a good set of guidelines on what you should do. In fact, I'll sum it up with you should probably close this trade by about 10:30 on Friday morning. That's about the simplest I can do it. Let's walk through it and let's see what we've got. First of all, this is the situation we've got. Earnings announcement tomorrow night at 4:15 or so, basically after the market closes. We are sitting in a situation on Nike where the short-term implied volatility is very, very high, 77.83 right now. We'll dig into what that real number is. And if you go out a little bit, actually not even very far, and we're down at about 27 and 25, 24. We've got some pretty low implied volatilities out here, which is great. This is exactly what we want. In fact, earlier today when we were talking about that sudden shock in the market trade, actually, Luther, that CBI situation back there, it's too late to do it now, but that CBI situation where the thing spiked up, that could have been an excellent opportunity to do that style of trade, that sudden surge trade. I'm not sure if it was, but that would have been something that I'd be looking for at that point. Anyhow, we're going to sell the short-term implied volatility, basically selling a put and a call, a short strangle, at about roughly the 1 standard deviation mark, probably a bit on the inside of that, to try to take advantage of this very, very high IV. And then to protect ourselves, we're going to go out and we're going to use less expensive, lower IV options and go long on them. Now, the idea is that after the earnings announcement happens, this price right here, or these implied volatilities, is going to collapse. The short-term option is going to be close to expiration. It's going to go to nearly nothing, making some money on that side. We're going to lose a little on the long-term option, but not nearly as much, and overall we should make some money. We need to figure out if the trade makes sense. We need to figure out if it's going to work. Little check boxes we need to go through. First step is let's set the trade up itself. Now, the Thinkorswim gives you the market maker move number. They have a tendency, they are absolutely overinflating this right now. Notice that this says implied volatility 77.85, and that gives us a plus or minus of $2.89. Well, implied volatility at the money, which is what we really care about, is a lot lower. I'm going to drop this down probably a fair amount, maybe down to about $2.50. So considering Nike is at $53 and basically 50 cents, I can go with a short 51 strike. That's $2.50. Oops. Yeah, short 51 strike. That's $2.50 lower than the current price. And the other side, on the call side, I'm going to add $2.50. So that would be $4.56. All right. So right now I have the beginnings of the trade. 51 strike on the put, 56 strike on the call. I am getting $1.05 in credit. But I can't take this trade for a big, huge list of reasons. The risk is outrageous. The margin on it would be stupid. The return on investment, because of the margin, would be low. And anyhow, just lots of reasons I don't want to take this trade by itself. But with a little bit of options magic, we can hedge off those risks and make a lot of that problem go away. I'm going to start out with the July 28th. I could move to the August 4th, but what I'm looking for right now is look where the implied volatilities start to settle out. You know, you can see it drops from 77, 78 down to 43, down to 34, 30, 27.50, 25, 25.4, 24.3. Okay, each one of these drops becomes smaller and smaller and smaller. Once we get to a point where the difference between the two is pretty much relatively negligible, we can start to use those as our long options. What we don't want to have is something with a high implied volatility that's going to drop a lot, causing the long options to lose a bunch of money. So in this case, I'm going to start out at the July 28th at about 27. As I said, I could go out to the August 4th. There's a trade-off, though. The further I go into the future, maybe there's a little bit less of a drop in implied volatility, but the Vega effect, the change in the price of the option for a 1% change in IV, gets larger, and at the same time my return on investment gets smaller because this is going to cost me more. So I've got a pretty strong incentive to try to get my long options as close to now as possible. So balancing off those needs, I'm going with July 28th. I need to get a 51 and a 56. 51 long, 56 long. Now, my $1.05 credit is now a 40-cent debit. This is actually a really good ratio. One thing I like to see, not absolutely critical, not a must-have, but better you get, the better you get out of this, the better off you are. I like to see the fact that my credit was substantially higher than my debit, just absolute value-wise. My credit was $1.05. My debit was 39 cents. That's good. So let's go to the analysis. So there we are. Hold on. Get rid of one of these. I already adjusted some of the implied volatility, so I need to clear that out so we get a better view of what this is. All right. This is what you should see when you set this trade up. Implied volatilities, the problem with this P&L chart right here that you're seeing is it assumes the implied volatilities stay exactly the way they are into the future. That's not what's actually going to happen. We need to figure out, most importantly, what happens to the implied volatility on these two legs right here. So to figure that out, I know where they are. I need to figure out where they're going to go and adjust them so that they go down there. Now, to do that, let's go back and do a little bit of research. We had an earnings announcement on March 21st. So earnings announcement was there. In this particular trade, we would have been exiting, is that right? January, March 21st? Yeah, we would have been exiting on the 22nd. Let me just step through this. Yeah, that was right. See, by the way, look at this. The implied volatility of the options that expired in 3 days, this is basically the same setup we've got right now, was up around 148%. This was pretty darn high. And then out here, these were up at 40%, and they dropped down to about 20%. Now, we want to figure out where these things are likely to go. In this sample, the implied volatilities of the long options actually hit down about 18. I'm just going to use at the money just to get a rough idea because we really don't know which way this thing will gap. Most of the time, implied volatility is further out or a little higher. The fat leg effect, or the fat tail effect. So there's that. Let's try it once more. Go back to December 20th. And earnings announcement that night, we would have been out the 21st. See, now this was going from, hold on, 99 to, okay, these longer term options were hitting about 23. So at the monies are about 19-ish. So 18% on one sample, 19% on another. Let's grab one or two more and we'll call it good. I just want to get a little information so I can make a rational judgment about these things. My swag, my scientific-based wild-ass guess. So 27, September 27th, we would have been getting out of this on the 28th. High implied volatility, 1 day further, drops down. Let's get on the 30 days out. And that is about 20%, 20 to 19, let's say 20% on this one. June 28th, would have been getting out the 29th. And that was 21%. All right, so we've got a pretty decent little range. Most of these are all falling into just about the same implied volatility range. I'm going to probably work on the lower end of this range, somewhere either a target of 19 or 18%. So let's go back here. We're currently at 27 and a little change. If I took, let me see here. If I took about 8.5% off of these two, that would put me right between the 18 and 19. So let's see what that does. So I'm taking the July 28th, subtracting 8.5% implied volatility. Now, this is actually going to hurt us, but we need to know how much it's going to hurt us to make sure the trade makes sense or not. Now, that would put us at an implied volatility of about 18.8%. Now, the majority of these samples we've had have been over that implied volatility. We had one less than that. I'm working on a pretty conservative low end on this thing. So if this were to happen, and here I can just do an adjustment on this one so we can look at it too, but it's not really it. The short options are expiring that day. The implied volatility adjustment is pretty insignificant on this, but I'll do it just for the heck of it. Say 75, and I want to get down to 18.8. So I'm going to subtract 56.2. You really don't need to do this to get a good understanding of the trade, but what the heck. There. Okay. So in theory, let's see. Yeah. You'll see changing that implied volatility really didn't change many things as far as the P&L of the trade on that day. In theory, we would be looking at this as our profile for the trade. Break-even points would be up around 58.20 and down at about 49.10. So one question is, do we think that it's likely that Nike is going to gap outside of that, causing us a problem? In the middle of the trade, we would be making about $200 versus the cost of the trade, which is about $400. That's pretty amazing, to be honest. That's actually 400. That's about a 50% return in the middle. Let's say 45% return, a little bit less than that. We've got a lot of room in here. Up closer to the strikes we're working with, we've got a ton more room. So we have a lot of possibilities in this trade. We've got a pretty decent area over which it's going to work. We do need to test it out. You know, number one, how many times has, let's see, how many times has Nike gapped down more than $4, up more than $5? How often does it make big, huge gaps? If it's a really common thing, this may not be a good trade. If we're comfortable that it's got a pretty decent chance of landing somewhere in this range, though, this could be a very solid, good, profitable trade. Let's just take a quick look at the chart and see. So this one right here closed at 58.68. Next day, hold on, 54.76. So that was about $4. That was one of the bigger gaps down. Little to nothing happened there. Almost nothing happened there. Remember, we do want to have some movement. We just don't want to have outrageous blow us way outside the trade movement. It moved during the day here, but that was more of an intraday move, not so much a gap. Gaps are more dangerous to us because they're uncontrollable. We're not able to manage the trade. That's only a couple bucks there. So close 57.40. So that one's about $4 also, moving up and down during the day. All right. There have been some times that would have brought us on this trade to the edge of the trade. You know, $5 would have been, let's see, 53.20, 57. $5 up or $4 up would have been about here, roughly. Oops, I didn't want to do that. This right here would be $5 up. $4 down would bring us right to the edge of this trade right here. That would put us right about there. So profit in the middle looks good. Potential max profit is great. Range, decent, but I do have to say we've been dealing with a couple of, in the past, Nike has gapped to pretty close to these points a couple of times. Not every time, and I didn't see one over the range that I looked at that was bigger than this. So do we want to take it? Couple of possibilities. We can take it right now, which actually I think wouldn't be a bad thing. There's a bit of a trade-off. We could potentially take this tomorrow night, right before the earnings announcement happens, maybe get some additional implied volatility in the short options. But you got to realize that between now and then, we've got some very short-term options here that are going to erode theta-wise. So the extra IV may not get us much of anything. I would almost rather just put it on right now. I think in general it looks pretty decent. Sandeep, I know that we have less profit if we spread out the strikes. Can we try doing that? You can do this, but it's a bad trade-off. I'll tell you that right now. You start making these too wide, and everybody always wants to do this. It doesn't really get you much. So let's take a look at what that does. Let me add in two things here. Okay. So there's one. That is the current break-even on the trade. And this is the other. So 58.03, 49.21. If I move this out, even a small amount, and there's not much room to do this, let's say you go to 57 by 50. And 57 by 50. Now, we do get some extra room out here, but we then, at the same exact time, created a spot in the middle where we can lose. Now, this actually becomes pretty problematic because if we don't have much of a movement, I always want to see a good solid profit in the middle. It doesn't have to be huge, but at least like 10, 15%. In this trade, we had almost 45 to 50% before we did this adjustment. The reason for that is that if Nike does not gap at all, just stays kind of stagnant in the middle, and this does happen. Don't think that it doesn't happen. If it stays stagnant in the middle, what's going to happen is implied volatility is going to drop more than we expected, and you end up taking a loss right in the middle of the trade. And I've seen that more times than I'm really happy with. So I've always wanted to take a decent profit margin in the middle of the trade. Now, by moving the trade out, we did move the break-evens out a little bit further. The peak profits, I'd have to double check exactly, where they were. But one of the things that it's hard to measure, but the amount of area underneath this curve here is kind of a combination of profitability versus probability. You want to have as much area under the curve as possible. And by dropping it down or widening it out too much, we've basically dropped it down to the point where we're actually reducing our area under the curve. So I probably wouldn't take it that way. I don't think it gets you as much as you would like, or at least I don't believe it does. And in the long run, I just think that we're better managing the trade and trying to control our risks, actively closing it than trying to make it too wide. If there's a ton of implied volatility and you've got a really, really good shot at a trade with a massive amount of profit in the middle, yeah, you can spend some of that profit and move your strikes out. That can be helpful. I don't think we have quite enough in this trade to make that idea worth it, though. So you can do it that way, but I'm going to take the more narrow trade. Some people go nuts on these things. Some people go very narrow and do much tighter trades than what I'm doing. And that changes the dynamic of the trade. Means that we have a potential for a very, very high return. In fact, over 100% over a decent wide range, but it's a narrower range. And we would lose faster if it gaps up. So it's a matter of balancing off these. Do you think that it's going to stay narrow and we want to go for a really high return on investment? Or do you think it's going to go a little wider and we want to protect ourselves by spreading things out? I'm going to give this one the original balance that we had. Okay. Any questions? Cindy, does that show you basically what you're dealing with? I'm not sure there's a perfect answer on that. If you believe it's going to gap further, use the wider ones, but just realize you're creating a greater risk in the middle. If you think it's going to be very, very narrow, go aggressive. You can narrow up the spreads or the difference in the strikes and get a much more profitable trade. All right, putting it on. So a couple things we need to sort out. I'm going to assume on this one that we're going to hit about a 25-cent loss. I'm doing that just for convenience purposes, but that gets us about the right point. So that's $25. That's 2,500 divided by 25. That would put on 100 of these. Now, a couple of things that we've got to pay attention to. There is lots of room for profit in this, and we are looking at probably 45, 50% in here, but some of this is going to get chewed up. This is a for contract trade. Some of it's going to get chewed up in commissions. So realize that off the bat. I wouldn't take a low price trade like this if we didn't have a good solid profitability in the middle. But we are going to lose some from commissions. I'm going to tone this one down just a little. I'm going to put it at probably put it at about 80 of these contracts overall. And do think this through as far as your own commissions and things are concerned too. You don't want to get caught having a great trade that you lose because commissions eat you up. There's this. Good, good, good. Confirm and send. And good. Now, we need to get a fill on this thing. I've got it at 42 cents. I don't want to probably go much past 44, but I am willing to chase it a little bit. I'm going to go up just a little here. Mid to natural, that's not super wide. Nike is a pretty well traded symbol. You should be able to get a decent fill on this thing. Maybe try 43. My personal recommendation is have some patience. There, I got filled almost instantly at 43. I think you're better off shooting for 42 and having a little patience to do it. But we got our entry, and I'm going to get this thing out as an alert. Now, here's the thing. Friday morning, I'm going to wake up. Basically, it really boils down to close the trade. If the thing gaps way out, it's past our break-even points or even past the strikes we used, there's a risk that the stock is going to continue moving against us, and we're going to want to close the trade. If the stock doesn't gap at all, if it stays dead center of everything, then you're going to have a risk of a little theta erosion against you during the day, and volatility tends to drop down a little bit during the day also. So my answer is close the trade. The only time that it is a really smart move to hold on and not close the trade first thing in the morning on Friday after this thing has its announcement is if you're pretty close to either 51 or 56. Now, problem with that is I probably would have hit my profit target on that. So I probably would have closed the trade. I'm going to put a profit target in on this at about 45%. I think that's pretty reasonable. We may not hit it. If you want to have a much higher probability of exiting, in fact, I might even drop it to 40%, just give us a really good solid chance of taking a good exit. So let me work through the numbers on that. And let me also get this alert out. John, yeah, there is a risk of price movement between today and tomorrow. I don't think it's outrageous. Actually, since we are doing this a day early, I'm going to put one more thing on here. I'm going to put a second profit target in. If we make 20% on this trade between now and tomorrow afternoon before the earnings announcement, take it off the table. I've seen that happen a bunch of times, and you can actually make pretty good money before the earnings announcement ever even happens. If you hit 20% return early, I'm not saying it's a high probability, but I have seen it happen. Walk with it. You have zero risk. You just got handed free money. So think about that one too. Yep, Luther, let me get this alert out, and then I'll walk you through what the CBI thing would have been. I'm not sure it's going to be there at this point, but let me get the alert out first so that people have this in their hands. By the way, if anybody wants the data on this thing, while I'm doing this, there you go. Okay, profit target wise, I got filled at 42 cents. I'm going to add a couple cents in, help cover some of the commissions, but 0.42 times 0.4 plus 0.4 All right, I'm going to put a profit target in here of just 60 cents, just going simple. Okay. Good. Sorry for the elephant stamping on the keyboard thing. There we go. See you, Luther. Yeah, that's about $1,400 profit if we hit that. Not bad for, basically 2 days worth of work. Nice thing about these trades is we're in and we're out. We've got a clear, we've got a clear win or a clear loss. Everything is pretty straightforward, not a lot of agonizing over it. Short term, it's a very good return on investment. On average, they tend to be pretty decent trades. Not every one of them, hits the full profit target. Some of them do take losses. It's just the process. More often than not, I'm winning these trades, and more often than not, I'm making a pretty good return on the trades. But we will have some losers in this too. Number one risk we have here is a really surprising big gap from Nike. That would be hurtful. That would be painful for us financially. If that happens, the goal is close the trade out as quick as possible. Bonus thing that happens is if that's a big surprising gap, especially if it gaps down, it's likely to create a situation where IB goes up, and that helps to reduce your losses a little bit. So that's kind of in our favor on this one. But it doesn't necessarily mean we're not going to walk away without a loss if a big gap down happens. This is a kind of a statistical trade. There's going to be some that are going to be bad, but over the life of the earnings season, we tend to have a fair number of these if we choose them well, set them up well, that work out well. And we end up more money in our pocket at the end of the season than we had in the beginning. That's the big goal. Any questions here? Yeah, we can put a profit of 57 cents, 54 cents for before tomorrow's close. I think that would be a good idea. Sorry, I was just rushing to get that report out, so I didn't add that in. But yes, if you get a fill of 54 cents between now and tomorrow at 4 o'clock, that's before the earnings announcement, take it, walk. You just made money. And so you might as well walk with the money. No risk, no issues with gaps, none of that stuff. So absolutely. All right, I'm going to wrap things up here. Hopefully I'm saying your name right, Rajnish. How am I setting my position sizing? Okay, let's walk through that real quick. When I'm doing these in this session, I am assuming and I'm working off of a hypothetical, this $100,000 portfolio. So this is how I size things. And you can adjust this to the way you work and what you want to take. But first of all, I'm assuming that the portfolio I'm managing is going to be a portfolio that's got an active set of trades of somewhere between 8 to 12 trades overall. And that gives me the diversification that I'd want in that type of a portfolio. And to do that, I need to allocate risk to each of my trades. Now, I like balancing the trades in the portfolio by the amount of risk that I'm taking. So what I would do is frame out the trade, set it up, sort it all out, and then think through what am I dealing with for risk. Now, in this trade right here, I actually put a little bit higher risk than I normally did. I said that I had the potential of losing 25 cents, which is actually almost 60% loss against this number. The higher the percentage loss, the smaller I'll end up scaling this trade. And I'll show you how that works in just a second. But I basically went into this and said that I could lose 25 cents on this, which I think is actually a bit large. I did that because this is not the most manageable trade. If the stock gaps in a radical way, I'm going to have to close out at whatever I can get. There's no magical formula to make it better. Now, if I had something that's a slower and steadier trade, I would use my stop loss eject point. So now I know that if I lose on one of these, in this case, I would lose $25. So my hypothetical portfolio is $100,000, and I know that just from experience that if I allocate 2.5% of that to each of my trades, I can manage a portfolio somewhere between 8 to, say, 14 different trades, diversified, well balanced. So if I'm going to lose $25 on one of these and I can allocate $2,500 to one of these trades, I would just do $2,500 divided by $25, and that tells me I could take up to 100 of these trades. Now, I don't know, maybe I wimped out, maybe I just felt like going a little small, maybe I just was a little worried that I'm not going to be here on Friday morning to make sure that we get a clean alert out on this. I ended up just mentally toning that down a bit and went down to 80. That just happened to be a choice I made this time. But the process is this. How much, figure out a rational way of managing the risk on the trade. How much would you lose per trade for one of these trades if you hit that? What is the max amount of risk that you're allocating per trade, and just divide the max risk by the risk per trade, and that tells you how many of the trades you can take, how many of the contracts you can take. The nice thing about doing it that way, at least in my mind, is it balances your portfolio out by risks. So everything is basically leveling out as in terms of the risk of each other is about the same in each trade. Depending on how you trade, some might be aggressive, some might be passive, but the risk-adjusted returns should all be ideally in your favor. And if you see a trade that's high risk and you think you can't control it, you would account for that, which would mean you would allocate a larger loss per trade, and that would automatically scale you down to the right size for your portfolio. So you can use that for yourself if you want. You can adjust it. You might allocate 2% of your portfolio to the risk of a trade. You might allocate 3 or 4. The higher percentage of your portfolio you allocate to each trade, the more concentrated your risk is in the portfolio and the fewer trades you can take. Smaller, more trades, more diversified, but more work. So there's your trade-off. So Rajnish, does that make sense? Does that understandable for you? Okay, good. Now, other people have different approaches, and I'm not saying their approach is wrong or my approach is right. This is just the one that I like to work with because it allows me to maintain a good, reasonable balance throughout my portfolio. Some people take max loss. I don't like that because I can have a trade that's got a massive max loss in it, but it's such a high probability trade of working, and I could easily stop loss the trade out well before it took a max loss. It doesn't make sense to allocate to limit that trade so much. That's why I choose what I would call a risk level. Now, something you need to understand, there is always the risk that you might lose a little bit more or maybe dramatically more than what you allocated for a risk level. You don't want to go nuts and make trades that are outrageous, but most of the time, 99.9% of the time, it works out pretty well, and it gives you a good sizing. All right. Anybody else have questions? I'm going to try to wrap things up, send off alerts, make sure everything's out. Everybody good? Any questions here? Going, and I guess gone. See you later, everybody. I will see you next week. Over the next couple of weeks, we are ramping up some content pieces for you, so keep an eye out on those. The Monday email that I sent out with all the kind of risks in the market view is going to be a regular feature. Before I take off, anybody has any other final thoughts on just little videos or informational pieces that they'd like to see? Send them into the chat right now. And other than that, I will see you all next week. Thank you very much, Mark. By the way, Mark, not a really big deal. It's just a procedure, but always fun. All right, everybody. Have a good week.